Mark Duvall, one stock you like at the Hennessy Equity and Income Fund is Bed Bath & Beyond. Stock's down around 10% in the past 3 months. So what's it going to take to turn Bed Bath & Beyond around?
Yeah, we purchased Bed Bath & Beyond last year for the fund, and the thesis was really built around many years of consistently high return on capital, operating margins, in a very tough environment, very competitive environment. So we're very attracted to the consistency in the business overall. Recent weakness has been really built around depressing margins because they have to spend more on omni-channel initiatives, internet retailing taking share. We think they'll be fine. One of the things that attracted us last year to the firm, outside of just the consistency of the business, was a change in management's use of the company's balance sheet. So we noticed they were going out and raising debt and using the low-cost debt proceeds to buy back their stock. In a process that we call balance sheet optimization, we think it's a great way to create shareholder value. So we like that, as well as some recent changes in their long-term incentives for management to focus more on return on capital. We think that bodes well for longer term for shareholders.
And you're also a fan of Deere & Company. Now, commodities have been falling. It's hurt the whole ag complex. Corn is down, soy is down. So how is this going to affect Deere?
Well, the way we invest at the Hennessy Equity and Income Fund, we typically start with high return on capital businesses that may be down a little bit for temporary differences like what we see with Deere. So we're looking at high return on capital businesses with shareholder-friendly management teams, with incentives aligned with shareholder growth. We think all those are set in place at Deere. No doubt the last couple of years we've seen crop prices decline, which is negative for farmers' income, which definitely flows through Hertz John Deere in terms of their equipment sales. But longer term, we think this is a very consistent business, high return on capital, and should be very good for shareholders over time.
You're also positive on CarMax. It's been down around 4%, 5% so far this year. That's after a big step up last year. So has it really topped out? Is this the end of the road for CarMax, I guess you can say?
No, I don't think it's the end of the road for CarMax. I mean, we've owned CarMax for many years. Really think it's a differentiated retail store model. So if you go to their stores, it's no haggle pricing. It's a separate finance deal, so you don't feel like you're having to deal with the same person on purchasing the car and then kind of getting screwed on the finance end of it. There's also a separate wholesale business where you can bring in your car and get it roughly blue book value and trade in. All those are separate parts of the deal, which other car dealers don't do. They operate about 150 stores now, so have only roughly 5% of the used car market. We think they can double their store base over time and get to probably 6 to 7% share without any issues. So I think the near-term weakness in the stock is a great buying opportunity. We're very bullish long-term in CarMax.
And then finally, you're a fan of Altria. Now, this stock has been figuratively smoking. It's up over 10% so far this year. Pays a nice dividend, almost 4%, I think. So it seems as though as long as people keep smoking, the stock's going to keep going.
I think that's true. I mean, Altria is a great example of our process. Everything we do with the Hennessy Equity and Income Fund is really focused on downside protection. So participating in up markets with much less volatility. Altria is a great example of that. High return on capital business in an oligopoly structured industry. Few players tend to be pricing power. So while cigarette volume is negative, pricing is certainly positive. Those high return on capital leads to significant cash flow generation. You mentioned the dividend yield. They pay back a significant amount of their earnings each year to dividends to shareholders. So roughly 4% dividend yield plus share repurchase really driving the stock. Still bullish on Altria.
All right, thanks a lot, Mark.
Thank you very much.
And thank you for watching The Street.